So I own some, blue chip shares. If they are high quality, how come they've dropped just as much or dropped as much as the market?
Yeah. Okay, so it's important to understand what happens when there's a market crash, right? And that gets back to that kind of what I was saying before about the buy and sell balance between things, because the vast majority of volume any given day on the market is driven by people who are just trading one thing for another. So they don't really care about. They care about the company and the prospects and the news, but they care about it from the expectation compared to what was already there, right? So if an analyst is looking at, say, BHP and its production numbers and how it's doing and what the markets and what the spot price for copper and whatever and coal or whatever, so they're looking at all that and they're saying, well, how does that play into their actual profitability and how does that compare to what I think the market's priced in, and is that going to be better or worse? And I'm going to buy and sell based on that. They don't really care about BHP's, what's the cost of their assets and, compared to their competitors and what's their long-term run and, what's their reserves and all those sort of things. They're factors in forming that opinion, but all they care about is the price going to go up and down when people realise something that I've just realised? That's what a trader's looking for, right? And so if they miss something and they're owning a bunch of resource companies and the market starts to tumble, not a resource-orientated thing, it's a virus, right? So a trader trades. Now, if you own things, just same as if you're Myer and David Jones put a sale on winter coats, right? And they say 50% off winter coats. And you don't do that. And you say, no, ours are still full price. No one's buying off you because they're coats. People don't fundamentally care too much. They just go, well, I don't really care where I buy them from, so I'll just buy stuff. So I'll go and buy off David Jones. And so the same thing happens in the markets. Again, traders don't care whether it's coats, T-shirts, whatever, commodities versus, US shares versus emerging market shares versus oil futures. They're just things they can trade. And so they'll either quickly try to get out of everything so they're not exposed because they're not selling their BHP shares for a higher price anytime soon. So you may as well get rid of them and buy something that you can do. In the same way that David Jones, when it gets to the end of winter, there's a sale on winter coats. Because it's like, well, we're not going to sell these anytime soon. So why have this capital sit there for all this time where we can't generate profits on it? So just get rid of it and replace it with something. Even if we don't make money, even if we lose a little bit of money on it, we can get that money back by trading something profitably over the next 6 months rather than hang on to it for next winter.
Yep.
So the same thing with traders. They do the same thing. So they're trading everything, trying to get in a position where they can now buy and sell profitably from whatever base they start. And because they're most of the volume in the market, they all load up on the sell side. And also they then start to see, well, how much can I get out of the other guy as well, right? So even if I want to go back in and buy, first of all, I don't want to buy into something that's falling because, again, I can't really sell it. I can maybe short sell to some degree, but I can't profit from the upside. So I want to wait till it's dropped a bit and then I'll start to. That's why you get these sort of dead cat bounces as well. And so it's important, I guess, from an investor's perspective that, to understand that while a blue chip share, it depends on valuation beforehand. So what we saw in markets coming up really for many, many years in recent times, and the one thing we were actually worried about in markets was this disconnect. There's two parts to it. One is there was a bunch of companies that have very high growth prospects where their prices have been bid up very, very high and the expectation these guys can make a lot of money. And so the valuations were very high. And there was also the very defensive side of the market where because there was no money in bonds and anything safe, there's a lot of money going into companies that were considered to be bond-like. They're safe, they've got good profits. We'd rather make 3 or 4% dividend out of them than 0.2 out of a bond. Right. So a lot of money chased those and bid those prices up. So as always, if you bought something for more than it was worth, you lost that money when you bought it. The fact that you're only realising it now that markets are normalising a little bit, then that's a different story. But you really lost it when you bought it. But if it's a genuine blue chip, good, solid company that was reasonably priced, the reason it got sold off is because it was just something to sell. And traders sell everything that there is to sell. They don't really care about, Microsoft is a more profitable, better defensive company than Netflix. Right. They just sell the whole lot. Now, it might drop a little bit less. So, yes, you might have dropped as much as the market because often your blue chips are also, if you take Australia, what people might refer to as blue chips like banks and mining and whatever, they really are the index, right? The top 20 stocks is on half the index. So if the index dropped by 20%, it's because the top 20 dropped by 20%. So but there'll be stocks that are down 70, 80%. If you look at, I saw like Afterpay, I noticed Afterpay went up 40% one day, and it was down that much in many other days as well. So that, if you look at the volatility, I mean, Afterpay, last I looked at it, had peaked at sort of $44 and got down to $9, and it was back up to 12 or 13 or whatever. Huge range of volatility. So a stock like that was very much based on its future earnings capability, way more volatile than a blue chip stock, someone like, BHP or CBA or something like that. That is a more predictable earnings-based company. But it also might be the fact that you might own that company in a sector that that the expectations changed, like banking stocks through the GFC. So again, it's a quality company. If you own good assets that are going to be okay in the long term, their price in any situation, especially these downturns, is largely irrelevant, because even if they were discounted, or even if they hadn't dropped as much, whatever, to really make any advantage, you have to sell them and buy something that's materially better. So even at the moment, you say, well, if I sell my whatever stock and buy whatever stock, I'm selling, at a discount to buy at a discount, unless there's a material difference. And there's rarely a huge difference between those during downturns, as generally everything's pretty much down.